once a bull market gets underway, and once you reach the point where everybody has made money no matter what system he or she followed, a crowd is attracted into the game that is responding not to interest rates and profits, but simply to the fact that it seems a mistake to be out of stocks. In effect, these people superimpose an I can't miss the party factor on top of the fundamental factors that drive the market. Like Pavlov's dog, these investors learn that when the bell rings, in this case, the one that opens the New York Stock Exchange at 9:30 a.m., they get fed. Through this daily reinforcement, they become convinced that there is a God, and that he wants them to get rich. Today, staring fixedly back at the road they just traveled, most investors have rosy expectations. A Paine and Gallup organization survey released in July shows that the least experienced investors, those who have invested for less than 5 years, expect annual returns over the next 10 years of 22.6%. Even those who have invested for more than 20 years are expecting 12.9%. Now, I'd like to argue that we can't come even remotely close to that 12.9% and make my case by examining the key value determining factors. Today, if an investor is to achieve juicy profits in the market over 10 years or 17 or 20, one or more of three things must happen. I'll delay talking about the last of them for a bit, but here are the first two. 1. Interest rates must fall further. If government interest rates, now at a level of about 6%, were to fall to 3%, that factor alone would come close to doubling the value of common stocks. Incidentally, if you think interest rates are going to do that or fall to the 1% that Japan has experienced, you should head for where you can really make a bundle. Bond options. 2. Corporate profitability in relation to GDP must rise. You know, someone once told me that New York has more lawyers than people. I think that's the same fellow who thinks profits will become larger than GDP. When you begin to expect the growth of a component factor to forever outpace that of the aggregate, you get into certain mathematical problems. In my opinion, you have to be wildly optimistic to believe that corporate profits as a percent of GDP can, for any sustained period, hold much above 6%. One thing keeping the percentage down will be competition, which is alive and well. In addition, there's a public policy point. If corporate investors, in aggregate, are going to eat an ever-growing portion of the American economic pie, some other group will have to settle for a smaller portion. That would justifiably raise political problems, and in my view, a major reslicing of the pie just isn't going to happen. So where do some reasonable assumptions lead us? Let's say that GDP grows at an average 5% a year, 3% real growth, which is pretty darn good, plus 2% inflation. If GDP grows at 5% and you don't have some help from interest rates, the aggregate value of equities is not going to grow a whole lot more. Yes, you can add on a bit of return from dividends. But with stocks selling where they are today, the importance of dividends to total return is way down from what it used to be. Narcan investors expect to score because companies are busy boosting their per-share earnings by buying in their stock. The offset here is that the companies are just about as busy issuing new stock, both through primary offerings and those ever-present stock options. So I come back to my postulation of 5% growth in GDP, and remind you that it is a limiting factor in the returns you're going to get. You cannot expect to forever realize a 12% annual increase, much less 22% in the valuation of American business, if its profitability is growing only at 5%. The inescapable fact is that the value of an asset, whatever its character, cannot over the long term grow faster than its earnings do. Now, maybe you'd like to argue a different case. Fair enough. But give me your assumptions. If you think the American public is going to make 12% a year in stocks, I think you have to say, for example, well, that's because I expect GDP to grow at 10% a year, dividends to add 2 percentage points to returns, and interest rates to stay at a constant level. Or you've got to rearrange these key variables in some other manner. The Tinkerbell approach clap if you believe just won't cut it. Beyond that, you need to remember that future returns are always affected by current valuations, and give some thought to what you're getting for your money in the stock market right now. Here are two 1998 figures for the Fortune 500. The companies in this universe account for about 75% of the value of all publicly owned American businesses, so when you look at the 500, you're really talking about America Incorporated Fortune 500. 1998 profits. $334,335 million. Market value on March 15, 1999. $9,907,233 million.